Everyone, one of the most common reasons why people fail when they try to engage in tax planning is because they're focused on the wrong things. So a lot of times taxpayers are focused on deductions. I need to get as many deductions as I can. It's going to reduce all my taxable income, and that's the way we engage in tax planning. And that's reinforced when they watch things on social media, TikTok, YouTube, or when they're reading different articles that deductions is everything. But you know what? Deductions are great. I mean, don't get me wrong, we want deductions, and that's an important part of tax planning, but it's not where our focus should be. What we need to be doing is we need to be focusing it on our adjusted gross income, right? It's the AGI. We need to focus on our AGI, and I'm going to tell you why. Because you may be taking deductions and you may not be getting a benefit because your AGI is too high. So, for example, your student loan interest deduction is based on AGI. So if you have too much of an AGI, you're not going to get that. Okay. It could deal with things like real estate. It could deal with credits is the other portion of it, right? If your AGI is too high, you're not going to get credits. Some of your credits are based on AGI. So the Earned Income Tax Credit, the American Opportunity Tax Credit, I mean, those things are going to be attached to AGI. So what we need to really be focused on is how do we manage our AGI? Because if we can control AGI, we can engage in tax planning, meaningful tax planning. And that's the purpose of this video. So I'm going to be walking you through AGI, and here's what we're going to do in this video. First, I'm going to show you the tax formula very briefly. We've talked about the tax formula in a couple of the other videos in our tax planning strategy series. But I'm going to show you the tax formula because I want to show you where AGI appears in the tax formula, just so we're on the same page. We're going to go gross incomes, then there's adjustments, and then AGI. Second thing I'm going to do is I've created a table, and it's going to show you where AGI is connected to some of these different deductions, credits, and other areas. So where are there phase outs? So that way you know, hey, if I want these deductions or these credits, I better be taking care of my AGI. I better make sure my AGI is where I need it to be. So we're going to take a look at that. And I'm going to give you an example as we're going through it after we look at the different relations between AGI and credits and deductions and some of the other areas. I'm going to give you an example where we're using some tax planning techniques and no tax planning techniques and how it's going to trickle through in terms of eventually getting to your tax liability. So that way you can actually see it in action. After you see it in action, what I'm going to do is I have a list, a table that I went through that shows you some of the more common ways that we can actually manage and control our AGI. So what types of things will reduce our AGI? So if you're trying to lower your AGI so you qualify for credits, you know what to look for. You know the controls in order to reduce your AGI. Okay? And then what I'll do is I'll conclude by talking about some common mistakes that taxpayers make when they engage in tax planning and they're focused on AGI. So we'll look at some mistakes. So hopefully you can learn from those mistakes and you won't encounter them yourself. So that is the purpose of this video. What I'm going to do now is I'm going to head over. I'm going to go show you our tax formula and where AGI appears on it. All right, so if you've been following along in the series, you've seen this formula before. But what I did is I went ahead and I've highlighted the AGI part. So this is a tax formula that we use when we're computing our taxes. We have our gross income minus adjustments, which are also known as above the line deductions. And that gets us to AGI, our adjusted gross income. That's what we're focusing on today. And we're going to see different ways to control AGI. A lot of them are going to go to the adjustments, and we'll talk about those different adjustments in order to reduce that AGI number. Once we have the AGI, you can see there's standard deductions and itemized deductions. If you're focusing on those itemized deductions, you're not lowering your AGI, and you're only going to be able to take those deductions if you're itemizing anyways. And since the itemized deduction, the standard deduction is over $15,000, you have to have over $15,000 worth of itemized deductions for any of those deductions to even make a difference in your taxes. And that's what gets us to taxable income. Then we have our tax rates to our tax liability. Once we get to the tax liability, we have those credits, and the credits are reducing our tax liability dollar for dollar. So remember, the credits are so important because it reduces it dollar for dollar. So if we have $1,000 credit, it reduces our liability, our tax liability, by $1,000. Okay, it's far better than what we get for deductions. Now, a lot of credits and even some of our deductions are going to be based on AGI, or you may see modified adjusted gross income, but the starting place to even get to your modified adjusted gross income is AGI. So we have to know AGI. That's why it's so important to control AGI, because if we want those credits, which we value immensely, well, we better make sure that we're not phased out. And the only way that we do that is to make sure our AGI is below the threshold amount. All right, well, with that said, let's go take a look at the different areas, the different deductions and the different credits that rely on AGI. So why do we want to reduce AGI? Well, let's see. Okay, so you can see the table here, and on the left in the blue is going to be deductions, and in the middle is going to be credits, and then in the green is going to be other. Now, I struggled with this table. And the reason I struggled with it is I know on videos like YouTube, sometimes it's a problem if you put too much information on here. I decided to do this anyways because I want this to be a meaningful tax planning video for you so you can actually employ some of the strategies that we're talking about. And I figured if you're watching the series, if you're really engaged in tax planning, this shouldn't be an issue. I think it's going to be okay with it. But if you need, you can always stop the video and write these down, take a picture, whatever it is that you need to do in order to have this information. I'm absolutely fine with. My purpose is to make sure you have the information. So let's talk about what is going on here. So we're dealing with AGI, and this is why we need to reduce our AGI. And that's why in the next section, I'm going to be talking about methods in order to reduce it. So we'll go through an example, then I'll talk about methods to reduce our AGI. But here's what we're looking at. These things that you see on this table all are directly impacted by AGI. So there's some type of phase out rule or something that harms us if our AGI is too high. So maybe we're looking at educator expenses, student loan interest, traditional IRAs, self-employment, health insurance deductions, right? So you know what? There's those different types of deductions, and it's going to be based on whether you have an AGI that's too high. So when we reduce our AGI, it opens up those deductions for you if you were near that threshold. Okay, so now we're getting to take additional deductions, which again will now reduce our taxable income. Now you can see I put in a red box under the deductions, and it starts with educator expenses and it ends with the self-employed health insurance deductions. I put that in a red box because I wanted to let you know those are those adjustments. When we looked at the tax formula, we said it was gross income minus adjustments. Those are some of the adjustments. So we call those above the line deductions that get us to AGI. Well, they're still based on what our AGI amount is. So I wanted you to see those are above the line deductions there. And then I left out charitable contributions. Let me tell you about charitable contributions. Charitable contributions are going to be deductible in 2026, even if you take the standard deduction. And then there's going to be a threshold for itemized deductions if you're taking itemized deductions for the charitable contribution. So we could have put the charitable deductions within the box area, but I decided just to go ahead and leave it out. But know that it has even more significance coming up here next year. Medical expenses, the 7.5% of AGI. So we have that. Casualty losses also are tied to AGI. So in order to take these, what we're wanting to do is we're going to go through and we need to reduce our AGI. So that's why we're going to want to see the strategies. Credits as well. Dollar for dollar. We love credits. Well, we better be careful with our AGI because we might phase out of the American Opportunity Tax Credit, the Earned Income Tax Credit, the Additional Child Tax Credit. Now, those are in a box because those are refundable. That can cause you a refund, at least partially refundable, and that can cause you to get a refund. Okay. Then the others like the Savers, Credit for Other Dependents, Lifetime Learning Credit, and the Child Independent Care Credit, they're not refundable, but it's still reducing us dollar for dollar until our tax liability hits zero. So, hey, that's great too, right? Well, all of those are tied to AGI, so it's possible that our AGI is too high that we're not qualifying for it. Now, we could go ahead and make less money and our AGI will go down, but generally we don't want to make less money. We want money, right? So we're looking at different strategies that we can use. So that way we're not necessarily making less money, but we're trying to reduce our AGI nonetheless. And then you can see there's other types of things like Roth IRA contribution eligibility. Look, that's on there because there is an initial requirement. However, there are backdoor Roths that we can look at, and we'll do a video on that so that way you can see how to handle those. But that video is still going to be a ways away. We have to get through the rest of our tax planning strategies, so we get to that. Net investment income tax, Medicare surcharges. So it's not even necessarily a tax, but you have your surcharges on that, your capital loss deduction, Social Security taxability, so how much is going to be taxed, and then your QBI deduction if you have a qualifying trade or business. So those are going to be the things that are impacted by AGI. So if we can reduce AGI, we open up these deductions if we've phased out before. So when you go to AGI, those are the things you want to look for. Is there anything I can do to my AGI in order to make sure I'm qualifying for these different deductions, credits, or other benefits? So let me walk you through an example, just a very quick example. And then what we'll do is we're going to talk about strategies in order to reduce our AGI so you qualify for all these things, at least based on your fact pattern. This is not a magic way it's going to say you're going to qualify for all of them, but we'll look for different techniques that you should be exploring so that way you know whether you're going to qualify for them. So let's go do that right now. Let's get to that example. So here's our example that we're looking at. And you can see in the blue, we're saying there is no AGI planning. And in the green, we're going to say that we are planning. So we can see what the difference is going to be, how it's going to impact us from a tax perspective. So what we have when we start going to the reddish area, that's our tax formula steps. So the first thing we have to know is what is our filing status, and I wanted to keep everything as simple as I could, so we're going to be single on both of them. Our W-2 wages are just going to be $90,000, so we only have W-2 wages. Adjustments to income. Remember when we went to the formula, we went with our gross income minus our adjustments, right? Those above the line deductions. Well, here what we're saying is we don't have any above the line adjustments. So there's nothing that's dealing with that. So we have zeros, which includes no traditional IRA, student loan interest. We don't have any of that. Educator expenses, none of that. So we're zeros all the way through. All right, that gets us to an AGI of $90,000 because we didn't have any above the line deductions. So our wages minus zero is going to be $90,000. All right, if that's $90,000, we subtract out the standard deduction because we're assuming we're doing just a standard deduction in both of these scenarios. So we subtract out the $15,750. Depends on when you're watching this video as to what the standard deduction is, so just take a look at it. But for purposes of this example, we're using $15,750. The taxable income is going to be $74,250. All right, we got to taxable income. Now what we have to do is we have to go through and start to apply our tax rates to it. We figure out our marginal tax rate, right? So generally we're going to have a higher marginal tax rate on those types of things. Credit eligibility, we might qualify for some credits, we might not. Now, when I went through with this example, I wasn't looking at the credit specific amounts. I just wanted to use this as a basic example. So now let's look at what happens if we have a taxpayer who's actually proactively engaging in their AGI planning. Okay, they're proactive about this and they want to minimize their tax liability. So they're still single, $90,000, but now they're going to have some adjustments to income. They have $8,800 of adjustments. And what I put as traditional IRA, they went ahead and they put $6,500 into their IRA. All right, so that's great. That's a traditional IRA. That's going to reduce our AGI. We have our student loan interest, $2,000. So we're going to go ahead and we're going to reduce our AGI by another $2,000. And then our educator expense. So in our example, we must have somebody who's probably single, K through 12. Well, they are single because that's their filing status. K through 12 educator. So they take the $300 here. So that's going to reduce AGI as well. So what we're going to do now is we're going to go through and we're going to say, well, we had $90,000 of gross income minus our adjustments to income, right? And that's going to put us all the way down to $81,200. So we're at $81,200. Now that we're at $81,200, what we're going to do is we're going to take the standard deduction of $15,750 because we're still not itemizing. And what that does is that brings our taxable income down to $65,450. Look at that, it's $8,800 less. Now you may be sitting there saying, okay, so all you did is told me that deductions reduces your taxable income. This isn't a hot take or anything, right? I mean, come on, that's common sense. Yeah, you're right about that. But let me explain. Let me explain why this really matters and how this really impacts you. So now that you have 65,450 is your taxable income, but the big thing is we reduced our AGI to 81,200. What that can do is that may impact our credit eligibility. Okay, we may have additional credits that we were phasing out of that we can now take. Because had we not taken the credit because we had too much AGI, we lose that dollar for dollar tax break. Here, once we reduce our AGI, it has a magnified effect of opening us up to additional credits that we previously would have made too much money for. So not only do we get the $8,800 based on the additional deductions we use, it may open us up to additional credits, dollar for dollar reduction in tax, right? And not only that, but those deductions that reduced our AGI also reduces our taxable income, which means we're at a lower marginal tax rate. We're likely at a lower marginal tax rate, which means we're paying less on our taxable income anyways. So we have a reduction in our taxable income. We have, which reduces our tax. So it reduces our marginal tax rate, and we have more credits that we're taking. So we now have effectively reduced our tax rate. We have an effective tax rate that is much lower than we otherwise would have. This is a magnifying effect that occurs when we are focusing on AGI as opposed to merely focusing on deductions. Otherwise, we might have been looking at some of those itemized deductions in there, or we may be trying to maximize deductions that we aren't going to really benefit from in certain aspects. Now, let me go ahead and start talking about some of these plans that we can use, or the techniques that we can use in order to reduce our AGI. So that's the next step here, is how do we reduce our AGI? After we go through that, I'll give you the different common mistakes that I see individuals making when they're doing their tax planning strategies. So let's go ahead and do that now. Okay, so here's our strategies that we can use to lower our AGI. So you can see on the left-hand side, we have the strategy, and then I give you in the middle the qualifications for it, and then additional information on the right-hand side of this. Okay, so these are all things that we're trying to do in order to reduce our AGI, so that way we're not phasing out on some of our deductions or credits, and it's helping us reduce our marginal tax rate in the current year and our taxable income. So this is what we're dealing with managing our AGI. We're controlling our AGI. So first one, contribute to a retirement account. Huge deal. Significant amounts of money, right? So if you have a 401k, $24,500 or $7,500 for a traditional IRA. And you know what? There's some catch-up provisions in there, like $1,000. That part's in there, but that's not the tax deductible part. So that's why I just left our primary amount of $24,500 and $7,500. That's going to change each year as we go through as well. So check the year that you're watching this. Make sure you have that amount down. It's pretty easy to find. The qualifications, again, 401ks, IRAs, there's some self-employment retirement accounts in there as well that you can look at. So another area, deduct student loan interest. Okay, so if you have qualifying expenses that you took out loans for and they're qualifying loans, then you can deduct interest up to $2,500. The more that you put into a retirement account, and if you're able to take those student loan interest deduction, those are part of the adjustments. That is reducing, okay, that is going to reduce our AGI. That's what we're trying to do here, right? We're trying to reduce our AGI, and there's two ways that we can reduce our AGI. When we looked at the formula as gross income minus the adjustments, well, we can reduce our gross income, and maybe there's things that we can exclude from income. You know, maybe we have the sale of the house, so we get $250,000 to exclude. If we're single, $500,000 in equity that we can exclude. If we are married filing jointly, maybe we have municipal bonds. right? So we're not having to pay taxes on that portion. Maybe we just didn't take a bonus, which generally is not a good idea. Take that bonus so you earned it. But that's the way that you're going to reduce your AGI, right? Now, you don't want to not take income, but there's certain things that you can exclude. Life insurance proceeds, if you receive life insurance proceeds, that's not going to be taxable to you, okay? So you're going to want to go ahead, and if you can exclude certain things in the income, that helps reduce our AGI. And then what we're doing here is we're looking at different ways that we can manage it through these deductions. And that's going to be the contribution to a retirement account so far, deducting to the student loan interest. The next one's going to be our HSA, our health savings account, right? Those are those high deductible health insurance plans. And that we get to contribute to that, and then we use them as we need them for healthcare expenses. That reduces our AGI. It's a great way to do it. And you can go up to $4,400 if you're single, or up to $8,750 if you're going to be with a family. So it's a decent amount of money that helps us reduce our AGI. And not only that, but you can deduct the amount that your employer is also contributing, which people sometimes overlook. So it still reduces our AGI. We love those things. Educator expenses. This one's kind of limited, K through 12. And unfortunately, the amount's kind of embarrassingly low for the amount that teachers contribute. My parents were teachers, or my mom was a teacher, and my grandparents were teachers. So I'm well aware of the amount of money that they often spend. K through 12 only, and it's $300 for an individual single teacher. If the teacher's married to another teacher and they both have those expenses, it can go up to $600. Okay, but that reduces your AGI there. Ordinary and necessary business expenses is a huge one, especially if you're self-employed. This is where it really comes in, right? You have all kinds of expenses. I've done a video on here that's talked about different types of home office expenses that you should be looking at. What can I deduct as part of my home office? Huge deal. You know, we talked in that video about things like you can depreciate part of your house, half your utility, well, not half your utilities, a portion of your utilities based upon the size of your offices compared to your overall house. So you can deduct some of that. Your home internet, some of that can be deductible. Maybe there had to be repair because there was a water leak, and you might be able to deduct some of that cost. Repairing a roof, some of those costs. There's a lot of things that can be deducted in that situation. But it's not only that. You have all kinds of expenses as a business anyways. And even if it's not a home office, you're going to have different expenses, such as rent. So you're going to be able to deduct those costs as well. So that's a huge area. That is considered an adjustment. So what we're doing is we're reducing our AGI, which is helping us qualify for all those other credits and for our different types of deductions that have that phase out amount that's based on our AGI. So you want to take a look at those. Now, something that's going to be important here is making sure that you're considered a trade or business or not a hobby. Because if you're considered a hobby, you're not going to be able to deduct any of that, right? It sucks to be considered a hobby. So what the IRS really looks at, and I have a video that talks about the different factors, but what it really boiled down to is profit. Did you have a profit motive? That's what the IRS is really looking at. Did you have a profit motive? If you're doing something for a profit instead of enjoyment, then it's generally going to be considered a trade or business, and they have a safe harbor. If you've been profitable 3 out of the last 5 years, they're going to say, yeah, you're probably a trade or business. Now, that's nice to have as a safe harbor, but when you're starting out as a business, a lot of times you don't have a profit for a few years because it takes time to get the business profitable. Doesn't mean you aren't going to be able to deduct it if you have less than 3 out of 5. You might still be a trade or business. It's just you have to show through your records what it is that you're doing. Maintain those records. You can do this. All right. Next one is the timing deductions and income. Your timing deductions and income. Okay, so we have timing deductions and income. So what I'm saying about that is there ways that you can defer income recognition, right? So if you're getting close to that phase out amount and you're not going to get those credits and you have control over when you're billing and you're a cash method taxpayer, maybe you bill in January and you collect that cash in January, right? Instead of December, because it's going to be based on when you collect the cash if you're a cash method taxpayer. So maybe you bill in January and it reduces your AGI for the current year. So that could be a method, or maybe there's a way that you can expedite some payments so that way we can reduce our taxable income this year, we can reduce our AGI this year. So using those timing differences, that was one of our last videos in the tax planning strategy. So take a look at that. And then finally, looking at the self-employment tax. Remember, if you're self-employed, you get half of your self-employment tax that you're able to deduct as an adjustment before you get to AGI. That's going to reduce your AGI. That's going to help save you a lot of money, especially if it gets over to helping you qualify for credits or other types of deductions. Now, I'm going to conclude this video with one last thing. I want to show you some of the common mistakes that taxpayers make when they're dealing with the whole AGI issue or tax planning issue. So we're going to look at that, and then we'll conclude this video. So let's go take a look right now. Okay, so here's the mistakes that taxpayers sometimes make. So be careful not to fall into these traps because it can cost you. The first one is not really planning it out. So being more reactionary and thinking, okay, I've got to just take a deduction and it's going to come out and it's going to work in the end. You need to be able to figure out what benefits specifically you're trying to achieve when you make these decisions, especially at the end of the tax year. So for example, if you're going to take, maybe you're at the end of the tax year and you say, you know what, I'm going to go ahead and I'm going to pay off my property taxes for next quarter or whatever. Or I'm going to go ahead and I'm going to pay whatever it is this year. And I want to be able to deduct the expense, right? I wanted to be able to deduct those property taxes. Okay, well, if you're not itemizing your deductions, it's not helping you. If you're taking a standard deduction, that's not going to help you at all. So you don't want to necessarily accelerate it, at least not for tax purposes. First off, property taxes, that's going to be an itemized deduction. It's not one of our adjustments. It's not going to lower our AGI. So all your itemized deductions, they don't lower our AGI. It's just the ones that I was talking about in the previous section of this video that's really reducing our AGI. Okay? So go ahead and make sure that you understand what it is that you're trying to accomplish and how that's going to actually impact you. So you're not just accelerating it because maybe next year you would have been itemizing. So you want to have that option available. The opposite side of that is deferring income into a higher tax year. So if you watch my videos or you watch a lot of other content out there, you might hear the rule of thumb of, hey, defer income recognition, accelerate deductions. That's good advice, general advice though. Your own tax situation matters. Okay, so if you're going to get a bonus next year, you just got a raise, something's happening this year where you're making more money next year, you might have a higher marginal tax rate. Well, if you go ahead and you try to take income that you could have recognized this year and you push it to next year, now you're going to be taxed at that higher marginal tax rate. So deferring income recognition can be a great strategy, but what you want to do is you want to make sure that you're not pushing it into a higher tax year. So if you're in a lower tax year this year, go ahead and recognize it this year and maybe not next year. Ignoring phase-outs and limitations. Okay, sometimes too much, the IRS or Congress thinks too much of something is not a good thing, right? So sometimes there's limits on how much you're going to be able to deduct. And you need to be aware of that, because if you don't know the phase-out and the limitations, you might keep trying to contribute things, but now you aren't getting that tax break any longer. You've put too much money into it, and it's great that you are contributing to whatever it is that you're contributing, but you may not be getting the tax break you think that you're going to actually be getting. So look at, is there a limit on how much I'm going to be able to deduct off of something? Or is there a phase out, right? Do I have to be worried about the phase out amounts as well? Documentation. Make sure you're documenting everything. You have to substantiate a lot of these claims, especially if you're going to be audited. You're going to have proof of all these things. Make sure you're keeping logs of mileage or whatever it is, because mileage, right, business expense. So we'd be able to deduct that to lower our AGI. Make sure you're maintaining those records so that way you're ready in case the IRS comes calling. And when you're working with your tax professional or you're doing your own taxes, you have accurate records. And assuming timing works the same for everyone. No, I've talked about this in other videos. Just because you're seeing this, just because you see tax planning strategies doesn't mean that they're going to work for you. And that goes to my videos as well. I give you all these different strategies out there, and this is what the whole series is about. But what you have to do is you have to look at your individual situation and say, does this make sense to me? Because some of these you're going to say, well, I make too much money. It doesn't apply to me. And others you're going to say, well, I don't really make enough. That's not going to help me. Or I don't really have real estate. So it's going to depend on your specific situation. So just because you see one person who's engaged in a tax planning activity, don't think that you can then extrapolate it to your situation. You need to look at your own situation before you try putting that tax planning strategy there. All right, this is what I wanted to cover for this video. So, go ahead and subscribe. Make sure you're following this series. What I'm going to be talking about in the next video is going to be the standard deduction versus the itemized deduction, and we're going to spend some time talking about those differences, so that way you know whether you should be taking the standard deduction or the itemized deduction and different things that are in the itemized deduction portion of it. So we'll go ahead and talk about that next time, but thank you for watching.